Williams Companies. The natural gas midstream giant, Transco, carries more gas than any other pipeline in North America, running 1,800 miles from the Gulf Coast to New York City.
FY 2025 revenue nearly $12 billion, with $7.4 billion in adjusted EBITDA. Q1 2026 was record-breaking. The AI data center boom is a generational growth catalyst for century-old infrastructure.
Williams was founded in Fort Smith, Arkansas in 1908. It built the Transco pipeline in 1956, a backbone still carrying the majority of Williams's EBITDA.
The Access Midstream acquisition in 2012 expanded Appalachian gathering in Marcellus and Utica. A $33 billion merger with Energy Transfer collapsed in 2015. Williams emerged as a standalone giant.
Williams signed a 164 million cubic feet per day data center supply deal in 2026, positioning Transco as fuel supply for the Northeast's AI infrastructure power plants.
Transmission and Gulf of Mexico generates 50% of EBITDA, led by Transco, with deepwater Gulf projects including Shenandoah, Whale, and Ballymore now coming online.
West and East gathering each contribute 25%, Haynesville, DJ Basin, and Rockies in the west, Appalachian, Marcellus, and Utica in the east. Williams operates 30,000 pipeline miles.
FY 2025 adjusted EBITDA $7.4 billion on nearly $12 billion in revenue. Cash flow of $6.5 billion funds 14 contracted Transco expansion projects, totaling $7 billion in growth capex.
Q1 2026 record adjusted EBITDA $2.25 billion, up 13%. Adjusted EPS 73 cents beat 63 cents by 16%. FY 2026 EBITDA guidance raised to $8.05 to $8.35 billion.
Kinder Morgan is the closest Transco analog, large U.S. pipeline with fee-based revenue. But Transco's Northeast focus gives Williams disproportionate exposure to the highest demand market in North America.
Energy Transfer and Targa focus on NGL processing rather than long-haul transmission. Less exposure to the high-value Transco expansion projects Williams is executing.
Williams's moat is geographic. Transco's right-of-way through the regulated Northeast cannot be replicated. Permitting a new long-haul gas pipeline in New England today would take a decade and may never happen.
Transco runs from the Gulf Coast through the Carolinas, Virginia, and New Jersey into New York City, passing every major East Coast metropolitan area and data center corridor.
The data center gas deal, 164 million cubic feet per day, is just the beginning. Williams has $3.1 billion in committed power projects for data center customers.
Chad Zamarin became CEO of Williams in July 2025, succeeding Alan Armstrong. He joined Williams in 2017 and previously led midstream operations at Cheniere Energy and NiSource.
Zamarin holds a BS from Purdue and an MBA from Houston. He chairs the Interstate Natural Gas Association of America and has built his career on large-scale gas infrastructure.
Williams Companies. The natural gas midstream giant, anchored by the Transco pipeline carrying more gas than any other conduit in North America, and now signed to deliver 164 million cubic feet per day to data center power plants across the Northeast.
Q1 2026, record adjusted EBITDA $2.25 billion, up 13% year over year. Adjusted EPS 73 cents beat the 63-cent estimate by 16%. FY 2026 EBITDA guidance raised to $8.05 to $8.35 billion.
30% of U.S. natural gas moves through Williams Companies pipes every single day. That number has never mattered more than right now, because AI data centers are about to make natural gas the most critical fuel in America, and Williams sits on the only pipeline that can deliver it at scale.
Williams Companies owns and operates Transco, the transcontinental gas pipeline, the highest volume natural gas pipeline in North America. That single pipeline runs approximately 1,800 miles from the Gulf Coast to New York City, carrying roughly 15% of all U.S. natural gas consumed daily.
Beyond Transco, Williams operates the Northwest Pipeline serving the Pacific Northwest, Mountain West transmission across the Rockies, Gulf of Mexico offshore gathering, and a west platform processing billions of cubic feet per day from the Marcellus and Haynesville shales. Revenue is almost entirely fee-based. Williams earns a tariff on every unit of gas that flows through its pipes, insulated from commodity price swings.
The stock trades near $58 with a market cap of roughly $71 billion. Williams is headquartered in Tulsa, Oklahoma, founded in 1908 as a construction company that grew into the backbone of American natural gas delivery.
Williams reported record Q1 2026 results on May 4th. Adjusted EBIT came in at $2.254 billion, up 13% year over year. Adjusted EPS of 73 cents beat the 63-cent consensus by 15.9%. GAAP net income was $864 million, up 25%.
Revenue was $3.03 billion. That missed the $3.17 billion consensus. But service revenues, the fee-based tariff business, grew $203 million year over year, driven by Transco's higher net rates, new expansion project volumes, and higher Gulf of Mexico gathering. Cash flow from operations hit $1.603 billion, up 12%. AFO reached $1.77 billion, up 22%.
On volumes, Transco averaged 16.0 MBenth of daily transportation. The West Gathering Platform delivered 6.37 billion cubic feet per day. Northeast Gathering ran at 4.01 billion cubic feet per day, and Gulf of Mexico Gathering contributed 0.76 billion cubic feet per day.
Williams raised full-year guidance to the upper half of the $8.05 to $8.35 billion adjusted EBITDA range. Adjusted EPS guidance is $2.20 to $2.38. Growth capital expenditures are guided at $7.0 to $7.6 billion, more than double last year's $3.4 billion.
2 transformative projects were announced. Project NEO is a 682-megawatt behind-the-meter natural gas power facility for AI data centers. A $2.3 billion, 12.5-year contract at a 5x build multiple, targeting in-service in 2028. The Atlas Agreement is 164 million cubic feet per day of Northeast data center gas infrastructure for less than $50 million in capital, completing by year-end 2026. Silver Spur Transmission adds 275 million cubic feet per day on the Northwest Pipeline into Idaho by 2030. The quarterly dividend was raised 5% to $2.10 annualized.
At the helm is Chad Zamarin, who became president and CEO in July 2025, succeeding Alan Armstrong after a planned leadership transition. Zamarin joined Williams in 2017 and led the New Energy Ventures Group before his promotion. He coined the phrase the era of pipes and power and is the architect of Williams' data center connectivity strategy.
The street is broadly bullish on Williams heading into the second half of 2026. The most powerful catalyst is what Goldman Sachs and Morgan Stanley are calling the AI to gas demand inflection. Every AI data center needs reliable power, and the fastest way to build reliable grid capacity in the U.S. is natural gas generation, meaning more gas demand, more Transco throughput, and more tariff revenue for Williams.
Analysts are also constructive on Williams' dividend growth story. The 5% raise announced with Q1 results extends a multi-year track record at a company that covers its payout nearly 3 times on an AFO basis. At roughly 3.6% yield with 5 to 10% annual growth, Williams offers a total return profile that income-oriented investors find genuinely difficult to replicate.
The LNG export build-out is the third catalyst. Williams gathers gas from the Haynesville and Marcellus, the 2 largest producing formations in the U.S., and announced 700 million cubic feet per day of new gathering expansion tied to LNG-linked demand. As Gulf Coast LNG export capacity triples over the next 5 years, Williams is positioned to be the upstream gathering infrastructure for that entire growth wave.
The doubling of the capital program is a double-edged sword. Bulls see it as maximum conviction that contracted returns are available at scale. Bears note that execution risk increases significantly when you double spending in a single year. The credibility of the data center pipeline, now with at least 2 signed contracts, is converting skeptics.
The bull case starts with the irreplaceability of Transco. CEO Zamarin noted on the call that Williams spent 13 years in litigation on the Atlantic Sunrise expansion and won every lawsuit. That timeline illustrates why no competing backbone will ever be built. The regulatory and permitting barriers are effectively insurmountable, making Transco an asset that will never be replicated.
Project NEO is a signed $2.3 billion, 12.5-year contract, not a speculative pipeline. If Williams replicates this model 5 or 10 more times over the next 3 years, the EBITDA growth implied is well above the current valuation. And the fee-based model delivered 13% EBITDA growth in a quarter where the broader energy sector was stressed by commodity price volatility. That defensive quality is genuinely rare.
The bear case opens with FERC regulatory risk. Transco tariffs are set by the Federal Energy Regulatory Commission, and shippers can challenge those rates in periodic rate cases. A ruling reducing the allowed return on Transco's rate base could create a step down in regulated cash flows that would be difficult to offset. Longer term, if battery storage costs keep falling and renewable generation scales, natural gas demand for power could peak within the decade, and Williams pipeline assets are designed to last 40 to 50 years.
The balance sheet demands attention. Williams carries $24.7 billion of net debt, with a target leverage ratio of 4.1 times EBITDA. The doubling of the capital program will require sustained debt market access at reasonable rates. Any credit market disruption or rating pressure would force a reduction in spending and disappoint growth expectations. And the Q1 revenue miss, even explained by commodity mix, is a reminder that Williams is not completely immune to macro headwinds.
Against peers, Williams commands a premium valuation for good reason. Enbridge is the closest comp, large-cap regulated pipeline, heavy dividend coverage, long growth track record, but carries more oil pipeline exposure and offers a higher current yield near 6%. Kinder Morgan has the most similar natural gas pipeline profile, with FERC-regulated tariffs and a fee-based model, but trades at a lower EV to EBITDA multiple, reflecting slower growth and Permian Basin concentration. Williams' AI data center positioning justifies a meaningful premium to both.
Energy Transfer is the largest MLP in the midstream complex, diversified across natural gas, NGL, crude, and refined products, and trades at a steep discount to Williams on virtually every metric. That discount reflects ET's more complex risk profile, its MLP tax structure, and higher commodity exposure. Williams' regulatory certainty and pure-play natural gas positioning command a structural premium that most institutional investors consider appropriate.
In the options market, WMB trades with a put-call ratio near 0.68, moderately bullish, and implied volatility at roughly the 42nd percentile, consistent with a regulated infrastructure company. The most active positioning is in longer-dated calls in the $65 to $70 range, representing institutional bets that data center power contracts will drive multiple expansion over the next 12 to 18 months.
Williams has raised its dividend 5% annually in recent years, and the 2.76 times AFO coverage gives substantial room for continued growth. The $2.10 annualized payout at the current price delivers approximately 3.6% current yield. For income portfolios, that combination of current yield, growth rate, and business quality, fee-based, regulated, irreplaceable infrastructure, is genuinely scarce.
Insider activity has been minimal, typical for large-cap regulated infrastructure. Management's primary signal is capital allocation, and doubling the growth program to more than $7 billion is about as clear a statement of conviction as exists. When a CEO bets 2 years of incremental capital on a thesis, that is a form of insider confidence that does not require a Form 4 filing.
The bottom line on Williams, record Q1 EBITDA of $2.254 billion, the 15.9% EPS beat, and Project NEO confirm execution on the most compelling infrastructure thesis in midstream. Watch additional data center power contract signings. Each adds contracted, multi-decade EBITDA at 5 times build multiples.
The key risk is the $7 billion capital program, the largest in Williams' history. The story requires trusting management can execute at this scale without stumbling.
That is the Williams Company's deep dive for Q1 2026. For more earnings analysis and investing education, subscribe to Charged Alpha at chargedalpha.com. New episodes every earnings season. I'm Lana.
And I'm Hudson. Everything we discuss on Charged Alpha is for informational and educational purposes only and does not constitute financial advice. All investments carry risk. Consult a qualified financial professional before making any investment decisions. We'll see you next time.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.